Hi everyone, welcome back to Be Rich. It's me, Vinod, recording for your Sunday video. The match is probably on and you've been watching it for some time. I hope you did take some time to watch this video. I'll try and keep it short and brief as promised because I'm watching the match too. Of course, I've recorded this earlier, so this is not a live video, so here goes. We have been going through something of a market downturn. Anand has been talking about this, I've been talking about this, and there's a lot of panic in our group. A lot of you are worried, what should you be doing? So today I thought I'll take this opportunity to kind of set your mind at ease and also give you a mindset. At the end of the video, I'll talk about strategies you should be employing for the rest of this time when we're facing this kind of a downturn. Remember, a bear market is a point in which value investors like you and me thrive. It is an opportunity, and these opportunities, when they present themselves, you should try and capitalize and make the most of it. That said, there are certain things you should keep in mind when you're capitalizing and making the most of it. One, assessing the current market and global trends is very important. First, you have to look at domestic factors, things you should keep an eye on going forward from now on. Interest rates. What is the RBI doing with interest rates is something you should keep an eye on. Corporate earnings. Quarter on quarter, you should see how the corporate earnings are doing. The more unstable the corporate earnings are, then there's a more likelihood there will be further price corrections. More the chances of the FIIs pulling out. Third, political stability. Fortunately enough, in India right now, we are facing a situation where we are very politically stable. This cannot be even said about something like the United States, where there seems to be a lot of uncertainty, though Trump has won in majority, if you can see what is currently happening there. And fourth thing which you should keep in mind is cyclical sectors like banking and infrastructure versus defensive sectors like FMCG and pharma sectors. So the news, what is happening in those cyclical investments like banking you should keep an eye on, and also news coming regarding pharma and FMCG, which are defensive stocks usually concerned, you should keep an eye on. This is domestically. Now what do you have to do globally? Where do you keep your eye when you're talking about global news? One, the American interest rate. The US is the global reserve currency, so of course you have to keep an eye on the US and the US dollar and what is happening with American interest rates. Two, what about global funds, meaning FIIs globally? What are they doing? Where is money going? Like you see it going into China, does it continue going into China, or is there a situation or a change where that is starting to slow down? If that slows down, where do you think the FIIs will go next? Because they're also looking for opportunities in the global market. So keeping an eye on that is very useful. Three, geopolitical risks. We've always thought the bedrock of our modern society is democracy and pluralism and liberalism, and Europe and America would be very stable. And right now we're facing a situation in this world where that whole thing is being brought into question. So there is a lot of political risk and instability. So keeping an eye on this is also important, because this may create further volatility in the market, creating further opportunities for us. Next, the currency fluctuations. What is happening with the Indian rupee versus the dollar? This is very important to also keep an eye on, because that is going to tell you about foreign inflow to India, and also if the effects of companies from India which are exporting and companies in India which are importing, and also of course the Indian economy where we rely on oil from outside India. How is that going to affect us? All this plays into the mix. So keeping an eye on what happens with the rupee and the dollar is also important. Finally, where you should keep an eye on is, thanks to AI, tech disruption seems imminent and it's already unfolding in various shapes and forms throughout the world. How severe is it going to be? How much is it going to be? Is something you should keep a track of and try to pay attention to, especially the companies you're investing in, the businesses you're looking at. It is important to realize how the tech sector is affecting all this. Now, what should be your strategy? Strategy, well, sticking to value investing principles. One, remember you're buying businesses, you're not buying a stock, you're not a stock trader, you're a business investor, so keep that in mind. Two, ignore all noises, right? Focus on the companies and the businesses and the sectors you're looking at, and news and information pertaining to that is important. Anything else is noise. People's opinions are noises, so learn to filter it out and focus on what you need to understand and learn so you can invest better. Three, margin of safety. This cannot be said enough. Margin of safety can be understood in many ways and forms, and you need to understand what margin of safety is. It could be financial, it could be a business brand, it could be the management, it could be anything. So learn to understand what margin of safety is. Of course, talking traditionally, margin of safety is the intrinsic value, which is considered like the book value of the company, And if the company has no debt and it has a good book value, you can be rest assured usually the price of the company will not drop below that, because each stock is intrinsically worth that much in terms of book value. But I need you to expand that further and look afield and see what else is there for in terms of margin of safety. Next, focus on earnings growth, right? Important is the cash flow. Free cash flow is very important. Any company that can generate free cash flow and has potential for earnings growth, or at least stable earnings, is something you should definitely keep on your list. These are the strategies which I want you to keep in mind. Next, we get into asset allocation. Great. So you got what all news is you must track. What is the strategy you must be employing in this bear market? Next, we get into asset allocation. Asset allocation we can look at as this. We have equity. 60% of our money or our investment should go into equities. Equities should be focused on, like I said, companies which are going to thrive post the downturn. You must realize this downturn or this instability we face in the world may seem like something that's going to be catastrophic and may last forever, but none of this do last forever. Like the good times did not last forever, even the bad times do not last forever. Thankfully, in history, if you look at, bad times usually tend to be much shorter in span compared to the good times. So how much ever this pain we're going to go through as a globe, as a nation, as a people, we will get through it and we'll see the other side in a short span of time. But during this time, invest 60% of your money in companies which will do well post this downturn which I'm talking about. Now 20% of your funds, your cash, should be in debt. Debt means bonds. Bonds give stable interest and they give stable returns. They may not be stellar compared to equities in the long run, but in situations like this, they offer you stable return in case this situation we are in goes on for a little longer than expected. Then 10% you can hedge your bets and hedge your risk by keeping it in international markets. If you have the luxury of doing that, then you can definitely look at putting at least 10% of your investments in international market. That means the American market, the Japanese market, through US, through the ADRs. So that is something you can investigate. And last 10% should be in gold. Before we used to say around 5% should be in gold, but considering all things, how gold is going to improve in terms of return, especially during this volatile time, and it hedges against any kind of severe downturn, it is good to have at least 10% in gold. Like my brother was saying in his previous video, those of you who have been following for some time, at least 2 years who have been following him, and you have been investing in gold like he's been asking you to, you'll be seeing such great returns in gold. Whatever pain you're suffering in an equity market will definitely be offset by the returns you're seeing in gold, which is very true. So this is why I'm saying at least keep 10% of your investments in gold. Now, what to do? Buy. During this run of fear which is happening, buy the stocks during fear and hold them for growth. So right now we are in an accumulation phase. That means we are not worried about anything other than, like I said, the metrics we spoke about, and we are in accumulation phase. So that means we're not worried about our price of averages. We're not worried about if you're making a loss or a profit too much, because we believe in the business, we believe in the company, and we know once this period is over, it will rebound and recover fast. So we are in an accumulation phase. So systematically invest in quality stocks. Some people look at dividend stocks as an option. You can, if you are into that strategy. But my only problem with dividend stocks is capital growth will not be as great as it is in non-dividend stocks. Companies which don't pay dividend too much or too great tend to grow better in terms of capital appreciation compared to companies which pay most of its cash flow, free cash, into dividends. So keep that in mind. And please, for heaven's sake, avoid companies which are over-leveraged. Companies which are over-leveraged really struggle during these economic downturns. In weak economies, they get hammered. So if you've been eyeing a company but its debt are very high, please avoid it. Don't think you can navigate this or get out of it by relying on these companies, because they may be big companies, they might be large caps, but if their debt is very heavy, trust me, they will struggle. And some of them in history have even disappeared. So be careful. Debt can destroy. That's why they've said very famously, even great empires finally fall because of debt, not because of the armies, not because of invasions. Most great empires in the world fail and fall and falter because of debt. This is even true with the British Empire. Now, please do not try to time the bottom of the market. Focus on companies that are out of favor of the market. If you see a company for no good reason being beaten by the market, that means there's an opportunity there. So focus on these companies which the market is throwing out the baby with the bathwater, as they say, because there are opportunities there. If you see those opportunities and you know your research and you know these companies fundamentally, then you know there's an opportunity. Don't get scared. Please avoid speculation. A lot of you are thinking of penny stocks and all that. Please avoid all this. Do not do any kinds of speculation. If you do not know what you're doing or you do not know a business or a company, it's better to avoid it than to speculate. There are some key metrics you must keep in mind. One is the PE ratio. Anything below 15 or depending on the company below 20 or 25 is considered to be good. You cannot hold these as golden rules or a golden number because it does depend, like we spoke about Jyoti Labs, from company to company and stock to stock. This does depend and change. PB ratio is great to look at for large banks and small banks. So if you're looking at a large bank, anything below 1.5 is usually considered a value. If it's a small bank and it's below 1, it is considered a value. So keep that in mind. Next metric we should try and look at is price to cash flow. That tells you how much free cash there is. For an FMCG or a pharma company, 10x, anything below 10x is good. If it's below 5, it's considered highly undervalued. So keep that in mind. Now, if you're new to this, the first time entering this, what do you do? Because some of you are. You suddenly seen me on Instagram. Someone has put you onto my brother Anand, and you've seen a few videos. And you've been seeing this market, and you feel like, oh my God, here's an opportunity. Everyone is saying, what do I do? You can do, but try and stick to this. Try and stay small in your investments. That is the Tiffin Coffee range. This is why I keep going on and on about it. 2. Pick. Keep 10 to 15 stocks, high quality stocks which you know about, which you understand, and try and accumulate them during this time. Don't go more than that because it'll get very difficult to keep an eye on it. 3. Remember, volatility is your friend. Anytime the market goes down, it's a good time for you. Especially if you're new, it can become rather nervous because you've put 100 rupees and you've seen it become 50 rupees and suddenly you're feeling very nervous about it. Remember, volatility is your friend if you're a value investor. Don't panic, and most importantly, don't overreact. That means suddenly you say, oh my God, the market has moved down tremendously today. I must put a lot more money in it. No, please do not do this. And finally, I'd like to leave you with this small thought in your head as you go back to the match and watch the match. And this is the final thought which I want to leave with you. That is, time in the market is better than timing the market. I want you to remember this simple thing to keep in your mind as you get back into your game, your match. I hope India wins today. I do not know because I'm recorded this earlier. I am supporting the boys in blue. I hope India wins, and I hope that is going to be a great evening for me too. Nothing else more to say. Have a wonderful evening. Hope India wins again. See you tomorrow as we start another week of investing, the first week of March, as we get into the last financial month for us Indians, because we go from March to March, April to March every year. So see you tomorrow with another video. Bye.